People who are wealthy understand that time is money. They earn money while they sleep, and by the end of this video, you're going to know how to do that too. Hi, I'm Greg Hardy, and we're going to discuss passive income and how much it'll take for you to never have to work again. But before we do that, I ask that you hit that like and subscribe button. It does great things for this channel, and it helps me to reach more people. Passive income is simply collecting earnings from an investment in which you are not actively involved. You can get paid money with minimal effort. Sounds great, doesn't it? Passive income gives you money coming in even as you work your primary job. It can also provide extra security in case of a slowdown in your primary job or a boost into your retirement savings. The IRS says passive income comes from two sources: rental property or a business in which one does not actively participate, such as being paid book royalties or stock dividends. Now let's be clear. It requires work to get passive income. That work is done in the beginning. The way to achieve passive income is to get your money to work for you. Let's first start by determining how much passive income you'll need. Let's start by adding up your total monthly living expenses. That will give you the number that you'll need to cover each month. I've recommended in my budgeting videos to take an average of your last 3 months worth of expenses. So let's go with that. Building a steady stream of passive income takes time and patience. So let's break it down into more bite-sized chunks. Your first goal should be to cover your necessary expenses. Think of things like your rent, mortgage, insurances, childcare. As you generate more income, you can then snowball that into more till eventually you get to your targeted amount. Let's talk about what investments can generate that type of income for you. First one is my favorite, and that is real estate. Having been in real estate for over 20 years now, this is where I'm the most comfortable investing. While I won't call rental property income completely passive, because it can be a real pain if you have difficult tenants, it can become more hands-off if you hire a property manager to handle that for you. Later in this video, I'll share with you a more passive approach to real estate. First, let's cover physical real estate. Rental property is a great way to earn extra income, but it usually requires more work than what people expect. Properties require maintenance and upkeep, and should the tenant decide not to pay, your income is, well, not there. There is a catch though. Real estate takes a few things to make it an option. You aren't paying cash for your rental property. You'll have to have a credit score above 725, preferably 750 or more. You'll have to have a stable income source and enough to cover a down payment. Lenders will typically require between 25 to 30% as a down payment for investors. Let's say you find a home for $200,000 that as it sits, you could rent for about $1,800 a month. With a 25% down payment, that would be $50,000. With a rate of 7%, investors have a higher rate than owner occupants do. Your payment, including taxes and insurance, would be around $1,400 a month. If you finance the home, your payment typically includes taxes and insurance in the payment. If you pay cash, then taxes and insurance would be a separate expense. Now, as far as expenses go, once you take possession of the home, let's take into account vacancy, which is the time that your home sits vacant before renting it or between tenants. I usually account for 1 month of vacancy each year as a buffer. Let's face it, if you're buying a home to rent, you shouldn't be paying market price anyways. You need to be patient and find a good deal. The money is made on the buy. With that said, expect the home to need some improvements. Therefore, we will need to factor in any repairs the home may need, like paint, floors, landscaping. I have all my homes painted the same color to keep things simple. Once the repairs are done, your potential rent of $1,800 is now, say, $2,000 a month. With the rent at $2,000 a month and your mortgage payment of $1,400, you have $600 per month in cash flow. In an ideal world, that would be an extra $7,200 a year. Multiply that by 2, 3, 4, 5 houses, and it can really add up. If you'd like to have a property manager take care of the home for you, expect to pay them about 10% of the gross rent. In this example, it would be $200 a month. I have a video on the 4 ways to make money by owning real estate that I encourage you to watch. I'll touch on them here briefly though. Those 4 ways include number 1, appreciation, which is the amount that the home increases in value over time. The second is through principal reduction. Every month that you make a payment, you chip away at that loan amount. Number 3 is cash flow, which is the difference between the rent collected and your expenses. And finally, tax advantages. That's right. the government gives tax breaks to rental property owners. Let me make one thing perfectly clear. Before you buy investment properties, I recommend either being debt-free or make sure that you can comfortably cover the mortgage and all of your other expenses in the event that your tenant doesn't pay. If you are solely depending on that tenant to make the payment for you, then it's a bad situation and you shouldn't do the deal, period. For a more passive approach to real estate, you can own a REIT, or a real estate investment trust. REITs are similar to a stock or mutual fund, as you can buy shares and hold them in your portfolio. They allow you to own property without physically owning the real estate itself. REITs invest in a wide scope of real estate property types, from warehouses, medical facilities, to shopping malls. They tend to pay an above average dividend, whether it's monthly or quarterly, which is money paid to you just for owning the stock. There are many types of REIT stocks out there, and they don't require much, if any, work to own as compared to physical real estate. They are much easier to liquidate than physical real estate. Liquidating simply means the process of turning an asset into cash. It can take months to sell a house. Selling a REIT can be done with the click of a button. An index fund is simply a collection of a wide variety of stocks and bonds. Some index funds are designed to mimic the overall stock market. Instead of buying hundreds of individual stocks, you can buy one fund at a much lower cost that has hundreds of stocks in it. Some examples are SCHB, which is a total stock market fund that Schwab offers. VT Sachs is another total stock market fund by Vanguard. And SPY, which is a fund designed to mimic the S&P 500, which is comprised of 500 large cap companies in the US. Whatever you want to invest in, there's probably a fund that has it. There are funds that focus on growth stocks. There are some that focus on higher paying dividend stocks. The list goes on and on. You can make passive income in 3 ways by owning index funds. One is the appreciation of the fund price from the point when you bought it to the point when you sell it. The other way is from the dividend that your fund pays you, whether it's monthly or quarterly. That's right, you get paid just for owning the index fund. The third way is if the fund increases the dividend payout. If your goal is to maximize dividends, there are funds like SCHD or VYM, which offer a higher dividend payout. Now, if you'd rather be a little bit more selective with the stocks that you own, you can buy individual stocks. When you're buying a stock, you're buying a small piece of that company. In return for owning some of the stock, companies will pay you for your investment in the form of a dividend. Dividends are the first of 3 ways you get paid when you own the stock. Now, stocks pay dividends either monthly, quarterly, semi-annually, or annually. The second is if the company decides to raise that dividend payout. And the third is if the stock price increases from the price you paid for it. Some stocks raise their dividend every year, and some have increased them for over 50 consecutive years. Those companies are called dividend aristocrats and include well-known companies like 3M, Chevron, Exxon, Johnson & Johnson, Coke, Pepsi, to name a few. With that being said, owning individual stocks are riskier because if they report bad earnings or some bad press comes out, that stock could take a hit. Whereas in a fund, each stock represents such a small percentage owned that it might not even affect the fund price at all. So investing in a good quality company should be primary and a dividend be the icing on the cake. Let's use Johnson & Johnson as an example. They pay a dividend of $4.76 per share, which based on the current price of $162.01 is a 2.93% dividend yield. To calculate the yield, simply take the dividend amount and divide it by the stock price. So if your average dividend portfolio pays a 3% dividend, you will need to invest roughly $1.7 million to make about $50,000 a year. If it's 5%, you'd need $1 million. While that seems like an unattainable number, you have time on your side. And by reinvesting the dividend income and buying more and more stocks, it will compound and grow. Whatever method or combination of methods you choose is personal preference, but above all, requires patience and consistency on your part. If you decide you want a more passive investment, you'll probably find yourself investing more heavily in stocks and index funds. If debt and increased risk aren't a deterrent, then maybe you'll invest more in physical real estate. This isn't a get-rich-quick method, and there are risks when it comes to investing. In fact, this could take decades and decades to accomplish. But I promise you, once you get started, it'll get easier and enable you to make a lot of money. With that said, thank you all so much for watching. I really hoped you liked this video and that you got something out of it. I encourage you to watch more videos as it relates to investing on this channel. And if you haven't already, please like and subscribe. Thanks for watching.